So there's been lots of talk from oil traders over in London at a conference talking about where oil is going to go. Vidal says 60 to 80 is the range. What do you see?
Well, I think obviously prices are up about a third since the beginning of the year, and that's really down to a couple of factors, really. There's a lot of geopolitical risk out there, and OPEC compliance is on the up. But if you break it down, Alex, I think if you look at demand remains strong. We're still above the 10-year average, we think, this year. Prices are still less than they were last year, $71 on average last year, so demand's strong. On the supply side, the U.S. shale machine keeps going, real growth there. OPEC is increasing compliance as the months go on. Russia coming out of winter, I think, easier for them to comply. Saudi Arabia certainly doing a lot. And then the geopolitics, Venezuela, humanitarian crisis, what's going to happen to sanctions in Iran. So it's an uncertain outlook, I think.
So is 60-80 fair?
I think it's probably a reasonable, fair for producers, fair for consumers. We try not to spend all our time trying to figure out what it is and really concentrate on the things that we can control.
So part of that is your production, and Trafigura at the same conference also said that the Permian Basin is going to be the biggest oil field in the world by 2023. BP now has BHP's interest in that. It's still relatively small. What are going to be your plans for that area?
So we took over the BHP assets on the 1st of March, so it is relatively fresh for us. We've got about 88,000 acres there. We'll grow the Permian position. We've got 3 areas we're focused on: the Haynesville, the Eagle Ford, the Permian. We're running about 16 rigs today. We'll probably start off with the majority of the investment in the Eagle Ford and the Haynesville. As the bottlenecks get unleashed, we'll shift more into the Permian.
Now, Exxon's spending $30 billion. Chevron's spending $22 billion, their overall CapEx program. You guys is between 15 and 17. How do you compete? How do you scale up when other big guys are like double the amount?
What we're trying to do is rebalance our portfolio in the United States. Today we have in the onshore we're about 85% gas. We produce about 10,000 barrels a day of liquids. What we're doing through this transaction is going from a business that produces about 10,000 barrels a day of oil, liquids, to a business that in the mid-2020s could be between 150 to 200,000 barrels a day.
So what is going to be sort of the future for you there? Is it going to be, how low of a cost of a barrel can you get? What technology can you use that you've seen the other guys try and you're like, oh, not doing that, going to try this instead?
I think the big technology for us is what we're doing, what the team is doing in the lower 48 around the digital oil field. Digital operations, digitizing the people in the field. I think there's extraordinary opportunity right across the portfolio, whether it be production improvements, cost improvements, or indeed environmental improvements. So what we're seeing, bringing people in from other sectors, it's why we place our headquarters in Denver. We believe we can attract people from different industries to the business to bring that digital skill.
Do you feel like you're going to scale quickly, or are you going to take your time?
We're going to grow the business. We've said that we're going to generate close to $1 billion of free cash flow from that business in 2021. So it's a material part of our growth plans.
So that's part of your 48 onshore area. What about other places? I know Libya, for example, they wound up having production come back online. They're counting on you guys, BP as well as some other national oil companies, to invest in the area. Will you be?
We're in Libya. We have an offshore position. We have an onshore position. We're working with partners there. We'll see how things evolve in Libya. I think the real uncertainty for price, as I said, is a whole number of factors. It's going to be around Venezuela, Iranian sanctions, what happens in Libya, what happens to demand. So Libya is part of the equation for sure, and we do have a position there.
So how do you reconcile then, as head of Upstream, when you're going to put a lot of money into, say, things like shale, and then that's going to come online quickly, you're going to have cash flow positive, and then all of a sudden oil prices are going to go down because you guys are spending so much and pumping so much. How do you deal with that?
We have to focus on our break-even, and that's what we're trying to do. We're trying to have a very flexible portfolio, which we've improved through the lower 48 transaction. We have a very diversified position. So we're in, today, the jungle in Papua building an LNG facility. We're in the deep water in the Gulf. We're in the desert in Oman. We're in the Arctic in Alaska. So we do a lot of different things, and we believe it's that diversity and that flexibility is how we thrive through this period of volatility.
And the other part is new energies, and that's why we're at Bloomberg NEF. So Goldman Sachs had a note out a couple weeks ago that said this is the time for oil majors. They're finally back on top, but it's strategically imperative for these companies to show they can reduce their carbon intensity. It's been a year for you guys since you really announced some targets. Where are you?
We're doing really well. We, as you said, 1 year ago we announced an accelerating energy transition framework. 3 parts: reduce our own emissions. Second part, improve our products. Third, create low-carbon businesses. On the reduce, we set 3 targets: methane intensity, emissions reductions, and zero net emissions growth. We're making great progress on those. 2.5 million tons delivered out of a target of 3.5. We've met our methane intensity target in 2018. We grew our business last year, but we shrunk our overall emissions, so we're doing really, really well. Tying our remuneration now, 35,000 employees to those reduction targets. And today, we're announcing a $100 million carbon fund to help come up with new ideas on how we can go further.
And that's separate from the $500 million that you've already committed to that area?
Too. It's in addition to.
Is that going to be enough? Because some say you need to spend even more, 13, 16%, even more, to get to where you need to get to.
Well, on the emissions, we've done a lot already. Our teams are absolutely engaged. The response so far has been overwhelming. Tying the remuneration is a way of accelerating it. Also, this $100 million is a way of accelerating it. So we find we can do a lot with what we've got. This is just a way of putting more energy into the system.
What do shareholders say when it's hard to get that return right away? They have to be patient to see any kind of return from investments in new energy?
Well, I think we have to be what we would say progressive and pragmatic in this space. There is a real need in the world to reduce carbon emissions. That is absolutely clear. And at the same time, the world needs more energy. A very simple fact, 80% of the people on the planet have never flown on an aircraft. 100 million people every year are going to take a flight for the first time over the next several years. So we've got to drive emissions down, we've got to drive energy up because that's what the world wants, and we've got to make sure we do it in a way that creates value for our shareholders.